Welcome to the Order Flows Trading Course, Lesson 4, Order Flow Terms. My name is Michael Valtos. I'm the founder of OrderFlows.com. First, a disclaimer. This presentation is for educational and information purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41. Hypothetical or simulated performance results have certain limitations unlike an actual performance record. Simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. So let's start. Order flow terms. Now, there are a lot of terms specific to order flow trading that you don't see in other forms of technical analysis. I've decided to list them here so that you can read them and see them. Don't worry if they don't make sense now. They will shortly as you go through this course. These slides are in alphabetical order. You can download the glossary of the terms in a PDF form to print out by visiting this page, orderflows.com/glossary. Now, all of these terms, like I said, they're in alphabetical order, so they're easy to find. Some terms have different names, but they have the same meaning. But you'll see that as we go through. Okay, aggressive buyers. Aggressive buyers are buyers who buy from the offer. The market will be bid and offered all the time. An aggressive buyer is someone that buys the offer. So, for example, at this price, 1908, the market is 1908 bid, offered at 1908 and a quarter. So the market's trading back and forth. Whoever's buying the 1908s and a quarter, those are considered the aggressive buyers. If someone was selling into the 1908 bid, you consider that aggressive sellers. So the next one is aggressive sellers. The sellers are who sell into the bid. So as I was saying before, people that are selling into this 1908 bid, these 49 lots that traded here, those are the aggressive sellers. Delta, ask delta. The total amount of volume traded on the offer in a bar, the amount bought by aggressive buyers. So you have down here, you can see on some charts, on some software, they'll show you what the ask delta is and what the bid delta is, the delta, the max delta. There's a lot of different types of deltas. One of them is the ask delta. And what it is, it's the volume that's traded on the offer. What was bought from the offer. When the market was 1915 at 1915 and a quarter, 1,666 lots traded on the offer. So you take the volume that's traded on the ask side versus what's traded on the bid side, you'll get the delta. But all the volume that's traded on the ask side, that is the ask delta. If you were to add up all these numbers here, you'd get 17,831. Bid delta is opposite of the ask delta. Again, it'll show up down here with your delta numbers. It's all the volume that's traded on the bid side. Okay, an average ratio number, aka a normal ratio number. Now, Order Flows Trader is the only software that has ratios. So if you're not using Order Flows Trader, this really won't make much sense to you. But a ratio number that is black color as opposed to a blue number indicates that the ratio is just normal. A regular ratio without price rejection or absorption. When you're going to see two types of numbers on the top of a bar or below a bar. If it's a red bar, it'll be on top. If it's a green bar, it'll be on the bottom. So in this case, you have a black number here, you have a blue number here. The black number is an average ratio number. It's one that doesn't meet the requirements of indicating that there's a lack of follow-through on a move or price rejection. Here you have a 90.5, here you have 2.067. I'll get into it later what the ratios mean, but for now, we'll just talk about the colors. An average ratio number is going to be black. A ratio that's in blue will indicate something like either strong offers, strong bids, or lack of buying or lack of selling. Next one is a buying imbalance. A buying imbalance occurs when buyers are aggressively buying from the offer at a ratio of 400% or greater relative to what's sold on the bid. So down here you have this buying imbalance. You have 49 against 263. The 263 is in blue, indicating a buying imbalance. You're taking the ratio of 49 against 263. It's over 400%. That's why it's showing up as a buying imbalance. Here you have 134 against 358. It's not a buying imbalance because 134 into 358 is less than 400%. The commitment of traders in order flows context, it is the price in a bar where the most volume occurs. So on most order flow software, they'll put a box around the commitment of traders. It's also called, point of control. You hear the term POC, COT, point of control, commitment of traders. In order flow context, on a footprint chart, they all have the same meaning. Some people like to refer to it as COT, others like to refer to it as point of control. And what it's telling you is where in the bar the most volume appeared. So you see here, you got 4614 and 4414. It just takes the price level. It's not measuring it diagonally, what traded against the bid, what's traded on the offer. It's taking the price level where the most volume occurred. Cumulative delta is the accumulation of delta over the entire trading session. You'll see down here cumulative delta. So each bar will have a delta of either 0, which is rare, or a positive or a negative number, and it's taking the cumulative number since the beginning of the session. So say it's a session that's been rallying, generally you'll have a positive cumulative delta. If you're in a session that's been selling off all day long, most often you should have a negative cumulative delta. Cumulative volume is the accumulation of volume over the entire trading session. It's going to be on the bottom here. With NinjaTrader, they put their copyright logo right over that, so you can't really see it, or at least the label. You can see the numbers, but you can't see that it says cumulative volume. And what that is, it's the day's volume. Why is that important? Well, you can judge if the market is fast or slow, busy or not, by the cumulative delta. By certain times of the day, you should have reached a certain amount of volume. On slow days or holidays, you'll notice that the volume is much lighter. And you can see that in the cumulative volume. Like you say, by 9:30, you should already have 500,000 contracts in the E-minis have traded. If it's much less, then the volume is light. Okay, the delta. The delta is the difference in a bar between the volume traded on the offer minus the volume traded on the bid. Now, you see also later positive delta and negative delta in the definitions. And delta is very important. It's something that not a lot of people look at all. Basically, only order flow traders really spend any time with delta. And, why is it important? On bars that are up, bars that open and then close higher. The bar opens down here at 1915 and a quarter, closes at 1917 and a quarter. It's an up bar. It should have positive delta. So you're taking what's traded, the ask delta minus the bid delta to get the total delta for the bar. So in an up move, when the market's rallying, you should string together positive deltas in each bar. There will be bars that are, red bars, negative bars that do have a positive delta, and there will be green bars that do have negative delta. Delta is a function of the volume that's traded inside the bar. It's important, I'll explain later. I have a whole chapter, a whole lesson developed around delta and its importance. But in general, on a move up, you should be having positive deltas. And on a move down, you should be having negative deltas. Divergence, in order flow terms, is when a market makes a new or equal high and the bar has a negative delta, or when a market makes a new or equal low and the bar has positive delta. Basically, price is acting different than an indicator. In this case, the indicator is the delta. So if you're making a high and you have negative delta, technically that's a divergence. People also refer to it as delta divergence. It's usually marked with a triangle on a chart. Most are, depending on some charts don't even show it. Why is that important? Well, you hit the high and there's a lot of selling in there causing a negative delta. That's important to know. You're not going to necessarily see that on just a normal bar chart. So if you can see, market's rallying, then you hit the high, and all of a sudden sellers come in and overwhelm the buyers, and you got a big negative delta like you have here, the market should react. Now, in a market that keeps rallying all day, you will get more and more deltas, just as maybe the market starts to pull back. You should take everything into context. I get into a little bit more with reversal signals later in the course. Footprint chart. This is a chart used by order flows trader. Footprint chart is the generic term that most order flow software uses to break down the volume traded on the bid and the offer. It provides the price, the bid traded volume, and the offer traded volume together. So you can see what traded on the bid, what traded on the offer, and how it compares with each other. And as the market's moving, it's called a footprint chart because imagine an animal walking through the mud, right? It leaves a footprint. Just as traders are trading through the market, they're leaving their footprint in the market as measured by volume. So imbalance on a high. Imbalance on a high occurs when there's a buying imbalance on the top of a red bar. What this means is it's a sell signal. You want to trade in the opposite direction. Some people will call it trap traders. I don't particularly like to use that term, trap traders, just because most markets are pretty liquid that, these guys they're trapped. They can get out pretty easily. But why is it important is imbalance on a high. Here you have the blue number, which is indicating a buying imbalance. So you got 221 against 1045. So it's a ratio of, 400% more that's traded on the offer. But why didn't the market rally? Keep going. You have a lot of aggressive buyers, people trying to buy the breakout, but they can't push it any further. It just stops right there. You want to take it in context with where the market is. If it's just an imbalance on the top of a red bar, the market going sideways, is it important? Yes, probably, but it's more powerful when it's, at the end of a move, rather than just sort of stuck in the middle of a move on a market that's going nowhere. I always say you can have the greatest indicator in the world, but if it shoots off a perfect signal right in the middle of a trading range where the market's going nowhere, it's not going to be very lucrative trading. So, the next one would be an imbalance on the low, which is opposite to the imbalance on a high. It occurs when there's a selling imbalance at the bottom of a green bar. And what you want to do is you want to trade in the opposite direction. So in this case, it would be a buy signal. So you see here, you've got 1068 right on the low. It's a selling imbalance. Well, people are being aggressive. They're selling it into the bid. Why isn't the market selling off more? Obviously, there was somebody in there with, a strong bid, a strong passive bid to support the market that basically they're saying, I'll take all you got. They're not going to let the market go through that level. They may be defending the level. Now, imbalances on highs and lows are not going to be, the end of trend, or the high or the low of the day. They happen in the course of trading. The market may come back to those levels later and, and test it and get through those levels. You don't necessarily know if those participants are still there when the market circles around back to those levels. But for the short term, it's, it's a nice little indicator to add to your cap, especially when you got to think about what's happening to the market. So you have the market coming down. You have some very aggressive sellers right at the low. The market turns around. Market price action of the bar shows that there's buyers in there. In this case, in this example, you've got a buying imbalance at the top end of the bar. So, these people that had sold earlier, they're stuck. They got to get out. If they want to get out, they're going to add to the buying. But what's important is the buying couldn't follow through, and that's where it turned. It turned because there was some decent stopping volume there in the market to absorb all the aggressive sellers. Okay, imbalance trigger in percent. It's the percentage used in determining if there is a buying or selling imbalance. The common accepted level is 400 as a minimum. Some people I know use 350. Some people I know use 1,000. 400% is a good starting point. Whether you want to be more selective or more, let a few more imbalances in, it's up to you. But most softwares will allow you to adjust the imbalance trigger percent. Imbalance volume threshold. Okay, now this is one that's unique to the order flows trader. You're only going to get it with the order flows trader. And what it is, it's the minimum traded volume on the bid or offer when there's an imbalance. It's important if you don't want to see imbalances where volume involved is less than a certain amount. For example, 10 lots. Setting it to a bigger number will show imbalances when more volume is in the imbalance. When it's taking, more volume to move the market. I have it set at 50. And I use that pretty much for all markets as the minimum. I don't want to see an imbalance of 1 against 6 or, 2 against 8. To me, technically those are imbalances because the ratio is greater than 400%. But if you're trading, thinner markets that, sometimes you're going to get, these markets, for example, some of the, green markets, even to a lesser extent, like NQ, NASDAQ, Mini Dow, DAX, even, you're going to get these bars that are moving around very fast, and you're getting ratios of 1 against 5. Technically that is an imbalance, but it's imbalances that's not necessarily occurring on very much volume. I like to see it when it matters, and when it matters is when there's decent volume that's traded. Okay, a large print on a bottom. Now, it's similar in the sense to an imbalance on the high or the low, only in this case it's a large print. It's not a it's not a imbalance. It's just it's very big stopping volume there, and what it indicates is there's heavy volume at the bottom of the bar. So I refer to it as stopping volume. It occurs at the bottom of a green candlestick when there's heavy volume traded at the extreme bottom of the bar, right here. Now it's most effective at swing lows or lows of the day, but it can occur in the middle of a move. And if it does, you could use it as a level to trade around. If you're already in the move, you could, if you like to trail your stop, you have this volume here, you can sort of hide behind, as the market goes up, if it's going to pull back, you could look to see how it reacts around there to decide if you're going to get out. But, like I said, it's most effective, I feel, when it's at the lows of the day or at a low of a move. It's basically someone coming in and supporting the market. Okay, a large print on the top. It's referred to as stopping volume. It's basically the mirror image of large print on the bottom, only this time it's at the top. It'll occur at the top of a red candlestick where there's heavy volume traded at the extreme top of the bar. Most effective at swing lows of the day, but can occur in a move. Now, the order flows trader software will give a ratio. That's why you see a blue number here, which is indicating that there is the volume at the top of the candlestick. If it was on a bottom, it would appear at the bottom. I'll get into the ratios a little bit later, but what's important to know is the large print on the top is oftentimes the beginning of the end of a move. The max delta, it indicates that the maximum delta exhibited in a bar at any point. So when you have a max delta, so you can see this candlestick here, the delta for the bar, it ended up at 1,630. The max delta, which was the most positive delta in the bar, was 2,630. So somewhere in there, it lost 1,000 lots of delta. So obviously there was some selling in there. I mean, it was very strong, got up to 2,630, but there was some selling, and it ended up just at 1,630. You know, in this next bar, this one here at 1141, you can see the max delta is 1778. The delta for the bar closed at 1773. The minimum delta was minus 1,644. So at one point in the bar, it had a delta of minus 1,644. Obviously, buying came in, and you had a positive delta of 1,778. The bar closed with a net delta of 1,733. Max delta, min deltas are, they're kind of important when the numbers are zero, either the max or the min, or when you see big shifts in delta when a bar was extremely negative, then it turns extremely positive. So the min delta sort of works the opposite way as maximum delta. It's the most negative delta in the bar during that bar. So this bar at 1125, it has a min delta of minus 0. So there was never a net negative delta since the bar started. It was always positive, even though, there is obviously volume traded into the bid side, but it wasn't enough to turn the delta, this number here, 1630, at any point to, minus 100 or anything like that. It was always on the positive side in the bar. So you see in this next bar, it has a min delta of minus 1644. It has a maximum delta of 1778. And the delta closed at 1733. So at one point in the bar, it did have a negative delta of minus 1,644 as its total highest negative delta. Obviously, buying came back later in the bar and turned the delta positive, and it went from minus 1644 to 0 to positive, and it traded all the way up to having a positive delta of 1778, and it ended at 1733. Negative delta indicates that more volume was sold into the bid. In other words, aggressive sellers were stronger than buyers. So, the delta, you're going to look at the delta number on a bar, and if it's positive, then it's positive delta. If it's negative, then it's considered negative delta. Why is it important? It's important when the market is moving up or down and you're stringing together negative deltas, the market should be moving lower. If you're up near the highs and you're starting to string together negative deltas and the market's not going anywhere, either the market has a propensity to later sell off or, go sideways for a while until selling sort of subsided. But, we'll get into the analysis of delta, later. But just understand when a bar has a delta number that's negative delta. If it's positive, that's positive delta. So, okay, a normal ratio number, aka average ratio number. I discussed it under average ratio number earlier, but it's a ratio number that is black color as opposed to a blue color. And it indicates that the ratio is just normal. it's a regular ratio without price rejection or absorption. It's just a number that, you expect to see in the market, right? The markets, exist to facilitate trade, and, that's what they're there for. So most of the times you're going to have average or ratio or normal ratio numbers. It's when you're going to get ratio numbers that are blue that something's happening in the market. So like in this case here, even though you have a buying imbalance on the top, the numbers, the volumes that are involved around this top, they're just average numbers. The one thing that stands out though is you have the buying imbalance at the top. I mean, it would be nice if it was also, the volume involved would kick off a ratio, but it does sometimes and sometimes it doesn't. Just like here, you have a single print, but you don't necessarily have the ratio. But, I'll get into explanation of the ratios a bit later. So, opposing bars. This is a term that I use often in the trading room. It's when two side-by-side bars are opposite in direction. A green candle followed by a red candle, or a red candle followed by a green candle. Usually you got the point of controls at the same levels. Like here, you got a red bar, you got a green bar following it, and you got point of controls right at the same level. And to a lesser extent, you got green, red, green, red, green. Once you start stringing together bars like that, especially when the point of controls are kind of, the same level, oftentimes it's an indication of a market that's going nowhere, is trading sideways. People can read into it a little bit more with the point of controls as being the support or resistance levels. But for me, I just find it when I start seeing opposing bars lined up in a row, it's usually a market that's going to go sideways. Passive buyers. Passive buyers are buyers who get filled while working a bid. So, there's two types of buyers. There's aggressive buyers and there's passive buyers. So, passive buyer is somebody that is working a limit order, whereas an aggressive buyer is someone who buys at the market. Imagine that you are trying to buy a car or you're trying to buy a house. You have a price you want to pay and you don't want to budge from that. You're considered a passive buyer. You're waiting for that person to come down and meet you at your price. You're waiting for the aggressive seller. Passive buyers are at every price level. When you see big passive buying in the market, you should pay attention to it. Numbers that really stick out quite strongly. Sometimes they're more obvious than not. But in a bar, you're going to get passive buyers, you're going to get passive sellers. When you're reading the order flow, you want to read what's sort of happening around the edges of the bars. Oftentimes will give you clues as to what's going on in the market. So passive sellers, again, it's opposite of what passive buyers are. These are sellers who get filled while working an offer. So, say the market's 1888 and 3/4 bid offered at 1889. The people that are trying to sell it at 1889 are the passive sellers. They're happy to sit there and wait for people to buy it at their price. So the point of control, again, it's oftentimes it's referred to as commitment of traders or COT. It's, in order flow context, it is the price of the bar where the most volume occurs. It's, going to have the box around it. Positive delta indicates that more volume was bought from the offer. In other words, aggressive buyers were stronger than aggressive sellers. So if you have a bar with positive delta, means net there was more volume traded on the offer, people buying the offer than people selling into the bid. Again, when the market's moving up, you expect to see positive delta. On a market that's moving down, you expect to see negative delta. Now, that's not always the case. There's times where you have a market that's sort of going sideways and you have positive deltas and negative deltas, and nobody's really in control. But delta is really very fascinating. I think I think it really, as far as analysis goes, can really tell you a lot about about what's happening in the market. So ratio bounds high. Okay, again, this is something that only order flows trader software has, and it's the ratio I use to determine if there's a small print occurring in a bar. I set my ratio bounds high at 28 because I want to be notified when there's a ratio above 28, which will indicate there's a small print at the edge of the bar. I refer to this as small print or single print. A single print is a volume between between 1 and 9. A small print will be a volume that's more than 10. What is important is the ratio number. It indicates a lack of follow through or a lack of buying or a lack of selling. It's a reversal indicator in general. It's this one. It's called ratio bounds high, and this is the setting. I'll talk about it a bit more when I get to small prints, but when I say ratio bounds high, it's a level that I use to determine if there's going to be a lack of buying follow through on a move up or a lack of selling on a move down. A ratio bounds low is what I use to determine if there's a large print occurring in a bar. I have my ratio bounds low set at 0.699 because I want to be notified when there's a ratio below 0.6999, which indicates there's a large print at the edge of a bar. So if it's at the bottom of a bar that's green, it'll be an indication of strong buying at the bottom of the bar. If it appears at the top of a red bar, it indicates strong offers up at the top of the bar. Again, I'll talk about I did talk about the ratios of the large print earlier, and this is what the setting is. It's the ratio bounds low. Again, it's something that's only available in the order flows trader software. A selling imbalance occurs when sellers are aggressively selling into the bid at a ratio of 400% or greater relative to what's sold at the bid. So here you got 769 against 112. The ratio of, when the market was 1929.5 bid, offered at 1929.75. 769 lots were sold into the bid versus only 112 were bought on the offer. So that ratio of 112 into 769 is greater than 400. That's why you have a selling imbalance there. It can help you determine, when sellers are really being aggressive in the market. Obviously, there's going to be time, everything that's sold into the bid is by aggressive sellers, but what you want to see is when the sellers are really being aggressive and you're stringing together, stacking up selling imbalances right in a row. Side-by-side point of control is when the point of control occurs at the same level in two consecutive bars. Here you have 1, 2 right at the same level, 1895. And why is it important? Well, the volume is in each bar is at the same point. And why is that important? Well, it's important because that's a price where all, most of the transactions in the bars were occurring. You can look at it, a lot of people take it to be support or resistance levels. If the market trades back up, in this case, it's originally this bar was green and then the bar turned around, it's red. We sold off a bit. We came back up around to the point of control, got through it a little bit, but then we started staying below it and the market sold off. Point of control is important to determine the support or resistance levels in a market. Okay, a single print. Now, a single print is, again, it's something, well, you can see it on any order flow chart, but in my software, the order flows trader software, will put a box around a single print, just to sort of make it stand out more. Because, sometimes you're looking at a lot of numbers and you tend to overlook things, whereas when you see it, with a box around it, it just stands out more. A single print is when there's a volume between 1 lot and 9 lots at the bottom of a green candlestick or at the top of a red candlestick here and here. The setting is ratio bounds high, which I had explained before. Small print is when the ratio bounds high prints a ratio number above 28. So a small print at the edge of a bar indicates a lack of buyers at the top of a red candlestick or a lack of sellers at the bottom of a green candlestick. Also see, ratio bounds high. This one here is actually a ratio bounds high, indicating that there's just, based on the volume numbers up here at the top, there's just a little bit heavier volume that traded on the top. This one down here, because it has a ratio of 45.06, which indicates a small print. 18 lots traded there. It's a ratio of the numbers involved. This is also a ratio of the numbers involved, but this is a ratio bounds low. This is indicating stopping volume. Again, it's a ratio that you're only going to see with the order flows trader. If you're just looking at this on regular software, you're not going to know that there's some, even though it's kind of hidden in there, it's really hard to see, and these numbers don't look that great, 1962, 245, 29. But it's indicating that there's some stopping volume, and the market did react off of it. Here you have the small print at the bottom of this green candlestick, and the market reacted off of it. When you see a small print, it's indicating that there was just lack of selling, when you're at the bottom of this bar, and the market turned around and closed higher. A stacked imbalance. Stacked imbalance occurs when there are 3 or more buying imbalances stacked on top of each other. That's, hence the term stacked. So here is a green stacked buying imbalance. We have the green zone drawn out. So you got buying imbalance, buying imbalance, buying imbalance. It's a form of support or resistance that's generated by market activity. So when you have a buying imbalance, stacked buying imbalance, and the market trades back in, you're looking for these buyers to come back in and reassert themselves and support the market and for the market to go higher. A stacked selling imbalance occurs when there are 3 or more selling imbalances stacked on top of each other. So in this case, you have, 4. You got the red zone drawn out here. And again, for selling imbalance, stacked selling imbalance, you're going to use it as resistance, whereas a stacked buying imbalance would be support, because you're looking for if the market to trade back up towards where these sellers were earlier, for these sellers to reappear and sort of push the market back down. Now, they don't always hold. Sometimes, these sellers, may just be a big order working its way through the market. And, once they get done, the market comes back up. It's something that, you should take it with context of what's going on in the market. Just because there's a stacked imbalance doesn't necessarily mean that, the market will be supported or meet resistance. Again, you should read it all into the context of what the market is doing. If you get in a stacked imbalance, either buying or selling, in the middle of a range, it's not as important as, say, a stacked imbalance at the high of the day or the low of the day. Stopping volume. Stopping volume is very similar to a large print. It occurs when there's heavy volume at the edge of a candle that turned at that point. Setting is under ratio bounds low in the order flow trader. And so you can see here is, you got up to 1900 and, just about 1899 3/4. And there's a ratio of 0.53. So it's indicating that there's heavy volume up here at the top of this bar that the market couldn't get past. And obviously the market sold off in this bar and then continued into the next bar. You see a big negative delta appearing. But this was a sign early that, hey, there's some volume, there's some sellers up here at these levels to, really, put their foot on the head of the market and keep it down. Unfinished business is when there's volume on both the bid and the offer at the top of it or the bottom of the candle. It's referred to as unfinished business, as the market often comes back to that level to finish that business later. Basically it's an unfinished auction, and the thinking behind it is that the market will come back and finish that business. you should have, a 0 on the right side of a green candle, on the left side of a red candle. When it's not, when you have volume on both sides, that's what's considered unfinished business, and you're looking for the market to come back and finish that business. Like in this case, the market opened up, down here, traded lower, but then came back and closed that, level off. Here you have another one, the market came right back up, and so on. Volume is, everybody should know what volume is. It's the amount of contracts traded in a bar. There's cumulative volume and there's just volume for the bar. In this case, I'm talking about volume for the bar. And so you can see 34,000, 37,000, 26,000. It's important because there's going to be times where bars have, very light volume, and you want to understand that and take it all into context with what's happening in the market. The volume imbalance is the difference between the volume traded on the offer and the volume traded on the bid. When the volume imbalance is over 400% on the offer side, it is called a buying imbalance. When there's volume imbalance over 400% on the bid side, it's called a selling imbalance. I had talked about these earlier with a buying imbalance or a selling imbalance. Here's just a general term. So you can see all the blue numbers as opposed to the black numbers inside a bar. If it's a blue number above or below, that's the ratio. That's the order flows trader ratio. But most software will indicate to you in the footprint where there's a volume imbalance. It's when you're starting to see multiple volume imbalances inside a bar, it's indicating whether or not the buying or selling is picked up. The volume profile. Volume profile shows how much volume is occurred at each price level throughout the trading session. It's plotted on the vertical axis of the chart. High volume nodes represent key areas of support and resistance, as well as low volume also is areas that people look at the markets to go back. I'm not going to get into volume profile very much in this course. It's something, it's available on the Order Flows Trader software, and profile trading has been around for a long time. I'll say a long time, 30 years. But there's a lot of good information out there on it already. It's most people already have a basic knowledge of it. It's something that people look at that helps them determine where there's support or resistance in the market. So that's the end of lesson 4, the order flow terms. In the next lesson, I'll discuss who are the market participants and why they matter and how to determine when they're active in the market. You want to know when the big traders are in the market. You don't necessarily care when the market's moving on small traders, but when there's real money hitting the market, real money accounts coming in and accumulating position or distributing their position, getting out, it's important to know because those are often beginnings or ends of trends. So thank you. This lesson 4 is over, and we'll start in lesson 5.